And so I'm going to be revisiting my original video on big lots, and I've been digging into the company a little bit, and this is what I've been finding. So I'm going to be bouncing back and forth here between some of the financial statements, and I also have page citations as well for applicable references for those of you that want to do your own due diligence, and I will post links to all the financial statements that I'm referencing here on the in the description box as well, for your references after the video. So right out of the gate, on page 58 in their most recently filed 10K, accelerated depreciation only gives a small boost to earnings and increases their deferred tax liability from $66 million in 2019 to well over $100 million in fiscal year 2020. And they increased their depreciation rate to reflect needed changes in dealing with their store of the future concept. Now, I'll pull this section up here. And depreciation expenses are very, very important to understand here. The increase was primarily driven by the continued rollout of their store of the future concept, their acquisition of their new corporate headquarters, and their investment in their California distribution center. And their expense as a percentage of net sales increased by 10 basis points compared to 2018. Prior to these few years, prior to the years before this, it actually decreased years prior, except for this 1 year, for the most recent one, recently finished. And you can see here, depreciation grew substantially from 124.9 million to 134.9 million in 2018 and 2019, respectively. Now, you can see here a few issues, I think. We in the last video, I adjusted for this and pulled out the needed adjustments. They sold off their California distribution center for $178.5 million, which accounted for 53% of operating profit for the entire fiscal year. So what I'm going to do again is show adjusted net income pulled out for the one-time expense of $242.4 million minus the $178,534,000. You get an adjusted net income of $63,930,000. So I'm going to put CFFO here. So you get an adjusted CFFO of $160,436,000. All right. This is a problem because then you see the depreciation expense increase is now 84.5% of cash flow from operations for the most recently finished fiscal year. And that's only sustainable up to a given point. Now, even then, even if you don't adjust for the one-time expense, you still have problems in terms of how CFFO is being represented here, because you still have to deal with the gain on disposition of property and equipment, because it is a one-time expense that they can only sell the same building only once. They can't sell the same building twice. And you can see here the growth from 483,732,000 to 177,996,000. So you can break that out as a percentage of unadjusted CFFO. And the percentages are almost the same, somewhat the same. The $178.5 million of selling the property and equipment was 53.34% of EBIT for fiscal year 2020. And if you would take the gain on disposition of property and equipment here and get it and have it reflect as a percentage of CFFO, it's still 52.5%. So you still have a large problem of how are they going to do this again? How are they going to be consistent about this? Because you can only sell a building once. Now, you also have this bigger issue of operating lease liabilities in 2019, and this is the one time that the company has actually pulled this up. Now they've been doing leaseback arrangements as a way to bring in capital to the company. Now, this also recognizes the fact that you need a buyer. This almost looks like a boomerang transaction just a little bit, because a leaseback transaction is, by definition, an asset previously owned by the seller is sold to someone else and then leased back to the first owner for a longer duration. They're doing this to raise capital, and the operating lease liabilities, because now instead of owning the asset, they lease the asset. Now it's boosting CFFO, which, fine, but it shouldn't be seen as a recurring expense. Now that, a recurring source of revenue, because this can only boost CFFO to a point, and that point doesn't seem to be lasting too long. So now you have to take out what percentage of operating lease liabilities makes up CFFO, and operating lease liabilities makes up 63.70% of CFFO for the most recently finished fiscal year. You have to ask yourself, how are they going to do this again? How are they going to be consistently doing this? Are they just going to flip property into the future? Can they get away with that? And even if you're okay with that, you still have to recognize that 178.5 million expense has to be pulled out because it's non-recurring. So what I'm going to do is I'm going to pull it back in and put the numbers back up. So 338.9 million minus 178, right? 160,436,000. So this is the adjusted CFFO that I'm running with, minus CapEx. You get negative free cash flow of $104,767,000 for the fiscal year. But they still paid a dividend of $48 million. I imagine that they're doing that with the cash that they garner from leaseback transactions to pay shareholders a dividend that does not need to be paid. And that seems like an imprudent use of capital. Now, go back to this page here. So right out the gate, you have a problem with negative free cash flow adjusted with CFFO adjusted for the one-time transactions, and once again realizing that CFFO is being unduly bulked up by certain transactions that can't be recurring by their nature. They can't sell that same one building consistently. They can't do that as part of their operations, because that's not why Big Lots exists. They're not a real estate flipper. They are a discount retailer. They're a closeout retailer. So now you have a big problem of CFFO being unhealthily bulked up and not giving a true representation of what the company can really do. And once again, I point this out here. Sale of distribution center was 53% of EBIT, and pre-tax income was only $139,014,000. Interest expense as a percentage of adjusted pre-tax profit grew to 10.79%. Up from 4.97% last year. So interest expense, being a financing expense reflected on the income statement, has grown rather significantly. The company has an incredible amount of debt, not too much, although free cash flow may be saying something different about that. With free cash flow being negative, the company can still sit on a 2018 credit agreement. They still have $700 million of extra liquidity that they can access at any given time. And that credit agreement has no borrowings on it as of the most recently finished quarter. You still have bigger problems, though, aside from liquidity. Day sales inventory has grown from 56.17 days in fiscal year 2011 to 63.16 days in fiscal year 2020. They can't really get a lot of this stuff off their books. And that was during good days. Okay. This was during a bull market. Now, let me pull up the spreadsheet. I'll put this up again in this video, too. They couldn't get inventory off their books in a bull market. Now, to be fair, they tend to sell high margin stuff like furniture, housing appliances, home decor, things that not everybody's really buying every single day. I mean, not everybody's going out and buying an ottoman or a footstool or couches every single day. And the demographic that they cater to, lower income, lower middle class, they're not really going out buying the same thing. They're not buying couches every single day. It's a very specific demographic. So I imagine the Big Lots demographic and the J.C. Penney demographic, they kind of blend together. They're people that want to feel like they're getting a good discount, they're getting a good bargain. People that feel as though they're not spending too much on something that they believe to have substantial value. That's the whole point of being a discount retailer. However, they can't seem to sell to this income class because they still have growing day sales inventory. So now, in 2019 fiscal year, 2019, they had the highest day sales inventory in the company's history at 67 and a half days, a little over 2 months to clear to have inventory clear out. This is not the sign of a company that's able to manage their working capital. Now, granted, again, they're selling high margin stuff. They're selling high margin furniture, which once again, not everybody's buying every day, but this still shows that this is growing in a rather unhealthy fashion. It doesn't bode them well in a recession like COVID, let alone when they couldn't get it off of their books in a bull market, when everything should be selling quickly. As I mentioned in the last video, liabilities have grown 14.88% over the past 10 years. Asset growth has trailed behind significantly at 7.82%. When adjusted for share buybacks, their capital base has grown faster than free cash flow and earnings per share. And while they've been paying a dividend that has been growing quickly as a percentage of net income, they seem to be very shareholder friendly in a rather dangerous way. While dividends and buybacks and other shareholder incentives are good and prudent in their time, this company does not need to be doing such things now. Adding back deferred taxes to equity leaves you with the company being 128.09% levered, while adjusting net income for the one-time expense of selling distribution center to leave CFFO for the most recent quarter, and I just covered this a minute or so ago, leaves you with negative free cash flow of $104,767,000. Although they are still compliant with their leverage ratios required by their credit agreement signed in 2018, which requires 4 times total debt to EBITDA, EBITDA being earnings before interest, taxes, depreciation, amortization, and rent. Now, for somewhat looking forward into the future, COVID cases are rising in the 4 states that give them 33% of their sales. Those states being California, Texas, Ohio, and Florida, where they have the highest store counts. And another shutdown of their supply chain or another round of mass closures will require them to draw down on their credit agreement, allowing them $700 million of extra liquidity if necessary. But they already have a lot of debt as is. So unless they want to take the risk of taking out another $700 million, which fine, they could probably manage around it, they're still having to deal with the long-term effects of another round of closures. How are we going to get our inventory off our books? Now, once again, I'm going to skip over here. I've mentioned I mentioned a minute ago, leaseback arrangements have been frequent as a need for raising capital in the company, but aggressive buybacks have still left the company more levered towards debt. The capital raise doesn't seem to be doing a whole lot, or it seems to be doing a wash because the company has limited their shares outstanding. So now they've lowered their cost of capital to a point, and all well and good, but they've also raised their cost of. They've also levered the company towards the higher cost of debt than the cost of equity. Now they're struggling to get inventory out, and they can't get rid of it without maybe either cutting prices or doing consignment sales and trying to find someone else to sell this stuff for them. And this is also assuming another round of COVID closures. So the only way that they're going to get this stuff off their books is if they cut prices and take a loss on them just to move things out, or they start doing consignment sales and still reduce their gross margins, which have been rather strong. They've been maintaining very healthy gross margins of 39 to 40 odd percent. That's a very profitable industry that they're in. But they're still struggling with inventory in a rather unhealthy fashion, and at a rather worse time to be struggling with bulky inventory. Now, the sale of the distribution center once again was 52.51% of fiscal year 2020. Fiscal year 2020's CFFO. An increase in operating lease liabilities was 63.70% on page 40 of their most recently filed 10K. This is what I actually find really fascinating, this next bullet point. Their EBIT margins trail their competitors. So margin comparison is an incredible way to try to figure out what companies they usually pay a little more attention to. So their direct competitors, I would say, are Ollie's, Bargain Outlet Holdings, Five Below, Dollar General. Their EBIT margins are low, 2.9%. As of the most recently finished fiscal year, Dollar General keeps 8.3%, Five Below 11.8%, Ollie's Bargain Outlet 12.2%. And then what I did was I tried to be a little more negotiable with, I guess, the company, and looked up their peer compensation review, which you'll find in the proxy statement. And every public company has to publish one of these things. So I'll make it simple. Control plus F, peer comp. And they explain here, in selecting the retailer peer group, they considered revenue, gross profit margin, geographic location, market cap, and number of stores in selecting a peer group. And they see themselves in the same line as Bed Bath & Beyond, Burlington Stores, Dick's Sporting Goods, Express, Foot Locker, L Brands. I would not put Big Lots and L Brands, the parent company for Victoria's Secret and Bath & Body Works, to be the same peer group for anything, but fine. I'm sure there's a demographic that sees these as alike and also desirable to shop in the same sitting. Ross, Tractor Supply, Urban Outfitters, and Williams-Sonoma. Okay, fine. All right, I'll run with that. And I looked at their EBIT margins to see if they're comparable to the peer group that they created, seemingly haphazardly. Because I'm still baffled that Big Lots would compare themselves to L Brands. Because who wants to go buy a futon and lingerie in the same sitting? I haven't figured that out yet. But if anybody knows the buying demographic that is willing to do that, show me them, and I want to meet these crazy people. So I looked at their EBIT margins, and I used QuickFS to do this, just a cursory glance without getting into the nitty gritty of these other companies. And they are still trailing. Even when you use Big Lots peer review peer group that they created, they're still trailing. L Brands having a 7.6% EBIT margin, Foot Locker 8.9%, and Big Lots still 2.9%. So no matter what, it doesn't seem like it's an economic issue. It sounds like a corporate problem. It sounds like the company is not being very well run, which is sad because this could be a very profitable business. And looking on to their 10Q for the most recently finished quarter, sale of distribution centers was 98.7% of their CFFO for this most recently finished for this current fiscal year of 2021 for the second quarter. Pulling the one-time sale out of CFFO leaves CFFO at $5,284,000 and free cash flow at negative $64,118,000, but they still paid a dividend of $24.8 million. So once again, you still have this problem of what are the company's priorities? Is it just to be a dividend bank? Because even then, there's only so much cash that can go around. So there's only so much cash that they can make to give back to shareholders. So I'm going to go here. Actually, before I do that, I'm going to go to the line item here, the line item page 15 of their most recently filed 10Q. They recognize a pre-tax gain on sale of distribution centers of $463.1 million. Okay, again, they can only sell so many distribution centers because they only have so many distribution centers. So 463.1. I'm going to go to the cash flow statement, and I'm going to just subtract that from CFFO. You get the $5,284,000 minus capex. And you get the negative $64,118,000. And then you take that negative $64,118,000 of free cash flow, or negative free cash flow, and then you look at the dividend that they paid, $24 million. I'm assuming that that's coming out of the leaseback proceeds. So, what is the takeaway of me mentioning all of this? Well, this could be a very profitable business. It doesn't seem to want to be all that profitable. It's not a problem on the gross profit scale. It seems to be a problem when it comes to how it's actually operating, and they're doing a lot of these one-time expenses to bulk up CFFO and try to give investors the image that they are growing CFFO at a rather significant rate, but only using one-time sales, because you can only sell only so many properties that you have, and then you can only sell a building once. Now, a building that they own once. The company, though in a profitable industry, as shown by healthy gross margins, seems to have more corporate issues than economic issues. Their EBIT margins trail competitors such as Ollie's and Five Below. And when adjusted for buybacks, their capital base has expanded rather than diminished, while free cash flow and EPS growth hasn't grown faster than their capital base. So immediately, shareholders are being diluted against the growth of total debt and total equity. And total debt and total equity when adjusted for share buybacks. And what I did in that to adjust for share buybacks, I took the amount of shares that were bought back by the company, put it back into took the purchased shares and put them back into outstanding shares, and then took the cash that was used to pay for the share buybacks back into the shareholders' equity account. I mentioned that in my last video. I'll link that in the description box below, as I give a bit of a more comprehensive treatment on how I accounted for such a thing. Now, their leaseback transactions can continue to be done to a point, and they can continue to buy back shares and pay the dividend out to a point. Their negative free cash flow should not be fooling anybody. These one-time sales in CFFO should not be fooling anybody. They're making up over half of the CFFO bulk. So once you account for these one-time sales, you're left with negative free cash flow, but the company still pays a dividend. So sooner or later, this has to stop. And they're still trying to make everybody happy through COVID, and still make shareholders happy by paying a dividend and being shareholder friendly, which it's a Herculean feat by any measure. But sooner or later, I think the reality will come in that this company hasn't had a whole lot of free cash flow growth outside of selling property. And there's only so much property that they own before they have to recognize that this business needs to be run better. Now, I will say, if you consider this for a short opportunity, once again, I'm not advocating for such a thing. The disclosure is here. This is for research and general pursuit of intellectual purposes here. This is not an investment recommendation. Your due diligence is your responsibility. It's your money at the end of the day. I am not responsible for it. But to be clear, if you were looking at this for a potential short idea, should you short it now? And my answer is no. And I'll say why. Because I think there's going to be a narrative switch in the market soon enough. If tech earnings tank, and the market finally admits, okay, we are in a recession. I think the story is going to switch from, okay, tech's not immune, but discount retailers are, because in these quote unquote hard economic times, people are going to want to shop at Big Lots, Five Below, Ollie's, Dollar General, Dollar Tree, Family Dollar, these cheap perceived value chains that offer customers more bang for their buck, seemingly, are going to be immune from the recession, and the narrative switch is going to move from tech isn't immune, fine, but discount retailers are, because everybody wants to shop cheap right now. Pockets are limited. People want to take their dollars and stretch them out as far as possible. So I think you have more upside on Big Lots before the downside is finally reflected. And I think it's going to be lauded as a cheap value stock because it's only trading at a PE of about 2.9. About 2.9 times earnings and a forward PE of about 8 times earnings. So it's going to be lauded as a value stock, I think, before the reality comes in of this company hasn't been growing value for shareholders. If anything, it's been diluting it. It's a bit heavily levered, and the negative free cash flow should not be fooling anybody. This company needs to do a bit better by their shareholders rather than just throwing cash in the form of buybacks and dividends. They need to start thinking about the long term of the company. If you like this content, please like, comment, critique, subscribe, any and all measure to help me become a better investor and understand companies better. I'll once again link all the relevant documents that I've referenced in this video, and I'll link my past video on Big Lots in the description box below. Thank you for your time.